All right, welcome to the Commercial Real Estate Playbook. It's your boy C-Todd Nambuya, multifamily owner operator and commercial real estate consultant. I help people acquire and close commercial real estate assets. Now, if you're going to be buying an apartment complex, whether it's 50 units, 100 units, 200 plus units, you want to watch this video because I'm going to give you some tips that are going to be very helpful in making sure that you acquire property the right way. All right, let's set the scenario. So you've been working, you've been looking at deals, you built relationships with brokers, and you're able to find an opportunity that you think is really going to be a good deal for you. It's some value add potential, good vintage, it's in a great market and sub market, it's in the path of development, so you know there's going to be upside, and you feel really good about this deal. Now you got some equity, your own equity, and you got some limited partners that are going to put capital into the project, and you're under contract, you go through due diligence, everything looks good, and then you close and then the celebration begins. You might want to go to the club, you want to get some bottles, you can go enjoy yourself, get a section, Magic City. I don't know however you want to celebrate your win, but you feel really good. You can even picture yourself pushing the Lambo, the Bentley, whatever kind of deal, whatever kind of car you want to get because you feel good and you know that you're going to make a killing of this asset. Now, fast forward, say 5 months. So at this point, you've owned the property for a while and you're fully in operation, but all hell has broken loose. So you're in a position where you done had 3 or 4 different property managers quit on you. Renovations are taking much longer than you expected. You're expecting to turn units to get them upgraded in 3 to 4 weeks, but now it's looking like 2, 3 months for every time you want to turn a unit, destroying your business plan. And worst of all, you're starting to run out of cash. So you don't want to be in this type of situation. So how do we prevent that? I'm going to give you some tips and things that you need to do before you buy so that you can be in a good position to have a smooth acquisition and a smooth operation. All right, number one, be patient. The only thing worse than not being able to buy a deal is buying a bad deal. So you want to make sure that you take your time and go through this process fully and be very thorough on how you acquire deals and make sure that you go through the full vetting process. It's going to take a lot of kissing of frogs and a lot of bad deals before you're able to find one that's very good, typically. And it's like what I like to say is like trying to find hay in a needle stack. Most deals are not they're not going to be deals. They're not going to be good acquisitions, not going to be good opportunities. And you just want to make sure that you properly filter and vet out every opportunity and be patient and take your time so that you can make the right acquisition for you and your partners. Number two, be well capitalized. People don't lose properties because they're not cash flowing. They lose properties because they run out of cash. So make sure that you have enough working capital and reserves and enough cash to be able to cover your capex and be just have enough cash on hand to be able to come up with a lot of situations that are going to come up. Like you want to be able to handle those situations as they arise because they will. Murphy's Law is at play here. Anything that can go wrong will, and it probably will happen. Probably like within the first few months of you owning it. There's gonna be certain things that you missed during due diligence, no matter how thorough you are. There's gonna be certain things that just come up just because life happens. So you want to make sure that you have enough cash to be able to handle those situations, and so that you don't run out of money. Number three, be an expert in your market or partner with somebody who is. Notice I didn't say just understand your market. I didn't say be familiar with your market. I said be an expert in your market. You really got to be able to understand the ins and outs of each market where you're investing because differences can happen between like one side of the street and the other. A market like Atlanta is so nuanced that I've seen so many investors just get cooked because they're from like New York and New Jersey or they're from somewhere else and they just look at Atlanta like, oh yes, Atlanta is a growing market, population, job growth, all of that. And they think that they can just buy a property that's close to the city and think that it's going to be the same. Like, no, like Buckhead is not the same as College Park. People literally will buy properties and think that like these markets, these submarkets are the same when they're very, very different. Even as far as like Decatur, like downtown Decatur versus Southside Decatur, like those are two completely different Decaturs. Like Hood Decatur versus gentrified Decatur is like two completely different markets. You're dealing with a completely different tenant base and a completely different asset. As soon as you drive that, as soon as you drive down Glenwood and past Candler Road, like you're in another city. But a lot of people don't know that if they don't live here. So you got to really understand your market. And you can do that by having a partner or hiring a consultant like me, be able to work with somebody who actually knows the market, and that can help you. But other than that, you got to really have that market knowledge. One thing that also helps is having a property manager that is really focused on that market, is very experienced. They can help you navigate the nuances of investing in one area. They can tell you a lot of the ins and outs of the market. But you yourself, as the operator, you need to have a good level of familiarity before you decide to invest in that market. You also want to know what's going on with local government. You want to go to economic development meetings, build relationships with the housing authorities and the people in the housing authorities. You want to really know what's going on and be on the up and up for new developments going on in the area or new things in terms of policy. And then when you want certain things, like if you want to get housing vouchers, if you want to get Section 8, you want to really know and have relationships, especially these are people that are going to be governing your property in a lot of ways. One thing that's helped us is we've had relationships with different housing authorities and economic development authorities where our properties are located. We've gone to town halls. We've spoken to the mayor and city council. A lot of that goes a long way when certain decisions are being made that affect your property. And outside of that, you want to make sure that you do a sub-market analysis when you're going to acquire a property. That means, running rental comps. You want to know what are the points of interest and the economic drivers around your property. All these things are going to have an impact on how you're going to be able to increase rents, and it's going to have an impact on the tenant base you're able to attract. So it's very important that you understand the ins and outs of the market. 4, stress test your underwriting. Trust but verify. Every single input into your underwriting model needs to be verified by a third party. So when it comes to like your revenue projections, your rent premiums, your expenses, you want to have your property manager sign off and know that they can achieve whatever it is you're trying to achieve. Actually have your property manager come up with a budget for you and compare that to what budget you're projecting to make sure that you guys are in alignment and they're not just saying yes to every number that you put in. You also want to have insurance brokers give you solid quotes. You want to give them as much information as you can on the property before you submit an offer so they can give you an accurate estimate of how much you're going to be able to pay of how much you're going to be able to pay. You want to build relationships with brokers because one thing that happens is if you try to get multiple insurance brokers, they're going to shop around to different carriers. And if multiple brokers try to approach that carrier, then one broker is going to get locked out. So you want to have a relationship with a solid broker, maybe a backup, but you don't want to try and just price shop with a whole bunch of different brokers because it's going to end up hurting you in the long run. You also want to have tax consultants. So yes, do your own research, talk to the county tax assessor. You want to be able to pull the tax bills and understand how they're assessing taxes. But at the same time, you want to have talk to a tax consultant because they do this every day. And they can even help you project if they feel like they can have taxes reassessed, they know what they can confidently get in terms of a tax reduction, and you can put that into your underwriting, which can make things a lot more competitive. Also, when you're going for financing, you want to talk to your lenders early and make sure that they know and can give you the accurate estimates of what you're going to be spending in terms of, your mortgage, what the insurance rates are going to look like, what is your prepay penalty. All these different factors go into you getting debt. You want to make sure that you figure that out and have confidence and get firm quotes going into any type of deal. Also, you want to be able to speak to contractors. So this is going to be part of your due diligence process. When you're walking units, you want to have GCs or somebody there that can accurately estimate what it's going to take to renovate each property to the standard you're looking for. One thing you want to implement into your underwriting models is sensitivity analysis. The sensitivity analysis allows you to stress test against varying metrics or inputs that go into it. For instance, if you're projecting an exit cap rate of 6%, but what happens if the exit cap is 7%? Or if you're projecting premiums of $250 above the current rents, but what happens if you only get $150 in increase? So, of course, these numbers are going to have a very big impact on how the property is going to perform and the returns you're going to get. So a sensitivity analysis allows you to see what your IRR, your equity multiple, whatever kind of metric you want to see as the output, you can see how that changes as these different variables change. So we want to make sure that your deal doesn't just work with the numbers that you input. You want to make sure that if some of these numbers slip and you don't quite hit your targets, that the deal still is viable and it still makes sense to buy. All right, real quick, if you're getting some value out of this video, which I hope you are, please go ahead and like, also subscribe. There are going to be a lot more videos going to be dropping, just giving more information, more value. So please go ahead, like, subscribe, and then leave a comment if there's anything you want to know more about. All right, five, you want to do thorough due diligence. So as I mentioned before, you want to pull the tax bills from the county. You want to talk to the county tax assessor, and you basically want to figure out, how much you can expect to pay taxes and how often the taxes are going to be assessed. So it's very important that you get that right because taxes can make or break a deal. So it's very important that you get that right. Also, if you're doing something like projecting any type of tax exemption, or if you're going to have some kind of tax abatement, whatever governing body is doing that for you, you want to make sure that you do your due diligence and understanding what the risk is, what their timeline is to approve it, how likely it is to be approved, or if you have some kind of confirmation beforehand, then that's ideal. But you need to make sure that you really understand that. Of course, in your underwriting process, you're going to look at your T12, your rent roll. If it's on market, there's going to be an offer memorandum. These things, of course, should have already been handled before you get to due diligence, but may do a quick once over to look at it again. Also, you want to look at your accounts receivable. You want to look at delinquency reports. You want to really look at understanding what does the bad debt look like. That's a killer for properties, especially if you're operating like with C-class properties, then that bad debt is going to be a killer. You'll have a fully occupied property and 20% of the property isn't even paying you. And if you're in a certain market where evictions take forever, that can really kill your cash flow and maybe even make it hard for you to meet debt service. So it's very important that you understand what does that delinquency rate look like at the property. And along with that, you want to understand how long does that particular county take to evict people, and it varies. A lot of municipalities still, as of 2025, are still recovering from the eviction moratorium after COVID. So a lot of them are still backed up. You got a lot of counties. Atlanta is actually pretty bad or notorious. They're getting better now, but Fulton and DeKalb, even Clayton County, are pretty bad with getting evictions done on time, or in a timely manner. It's better now, but that can be a real deal breaker. So you understand, what does that delinquency rate look like, and how can you best mitigate it on the front end. You also want to walk all the units. And I mean all of the units, as many as possible. May have maybe some where you just can't access, but the overwhelming majority of the units on the property you should walk. You don't need to do it by yourself. You want to have a team. If you have your property manager coming in before you acquire, which you should, and they're along for the ride during due diligence, you should have them walk units with you. You should have a contractor there, as I mentioned earlier, so you can get a pretty good understanding of what needs to be done in certain units. And you want to document everything. You want to take pictures. You want to take a note of the condition of like the flooring, the appliances, paint, etc. You want to get a decent idea of what's in there, so you know what's going to be needed to be able to renovate each unit and get it to the standard that you want to achieve your rent premiums. You also want to do full financial due diligence, so reviewing operating statements for the past couple of years, reviewing rent rolls for the past couple of years. You want to review bank statements and make sure that they line up. You want to look at contracts that they have, like for trash or for pest control. You want to see what those contracts look like. You also want to see utility bills and make sure that everything you saw in the T12 and the financials are corroborating what you're seeing in the bills. So it's a lot of work that goes into it. A lot of times, sellers, they may try to hide stuff, but a lot of times it may just be them not knowing or them missing something. So you, as the buyer, you need to make sure that whatever asset you're acquiring, it, you need to be doing your homework to make sure that you're acquiring something and you know what you're buying beforehand. That way, during the contract period, if you need to negotiate, you have the leverage to do so because you haven't bought anything, and you're able to make any changes or ask for any concessions based on what you uncovered during due diligence. Number six, you want to have multiple strategies and contingencies. Like Tyson said, that everybody got a plan until they get punched in the face, and that's exactly what's going to happen when you take over that property and you start operating. Something's going to happen. Like there's going to be so many issues, so many fires to put out, and a lot of times your strategy, or pretty much every single time, your strategy that you planned, everything you're performing, is not going to go as planned. So you want to be able to have multiple exit strategies. You want to have multiple contingencies and backup plans, so if one thing doesn't happen, you already kind of have an idea of what you can do. What's going to happen if you don't meet the rent premiums that you projected? What are you going to do if you have a harder time evicting tenants that aren't paying? How are you going to handle things when you have materials that you're supposed to use for your renovation, but they're on back order and it's going to take a couple months or whatever before you can get them there? There's always going to be something that comes up. So you want to be flexible. And the best thing you can do is think about these contingencies ahead of time. So think through your business plan, think about all of the stuff that's going to be necessary, think about all of the necessary steps to be able to accomplish every single part of your strategy, every single part of your value add if you're doing a value add, and you want to think through what if something falls through. Now, of course, you're not going to be able to predict everything, but like Dwight Eisenhower said, plans are nothing, but planning is everything. So you want to be able to think through, what your contingencies or how you're going to adjust when things go awry. You want to be able to plan for like an earlier or later exit. So you want to have a business plan that's flexible and resilient to be able to adapt to different things. So if you need to exit in 3 years instead of five, if you have a 5 to 7 year business plan, or if you need to hold for 10 years, you want to be able to see what that looks like and be able to adjust. Number seven, properly vet your property manager. This is crucial. Now, of course, the most important roles are going to be whoever's sitting in that property manager seat, like in the leasing office, and then who the regional manager is going to be from your third party property management if you go that route. Those are the two most important roles when it comes to your property's operation. I've seen properties change night and day from going from not performing at all to exceeding expectations by those roles changing. So it's very important that you have good people in those roles. A lot of times those roles won't be filled until you acquire the property and then your management takes over. So you can put yourself in the best position on the front end by properly vetting the property management firm that's going to be operating your property. So one thing you want to make sure is they need to have specific experience with the type of property that you're dealing with. You want to have experience in the particular market and ideally the same submarket, similar property type. If there's any particular restrictions, like if you have an affordable housing property or a senior property or student housing, they need to have a lot of experience with that particular type of asset class because all the different nuances, all different things that come with operating those types of properties, they need to be able to be well versed in those things. The best way to find property managers that you can hire is to ask for referrals. You want to get referrals from successful operators that are in similar asset class as you. Those referrals go a long way because word of mouth is somebody that can vouch for them and that has seen them do work. That's the best thing you can do. And then once you get these referrals, once you get these property managers, you want to interview them. You want to have conversations, ideally more than one conversation to really be able to vet them out. I have a list of interview questions or a list of questions in general to be able to ask property management, but you want to know certain things about like how they handle leasing, how they handle late payers, how they handle delinquent units, what's their process for turning units, how do they hire, how do they handle their books, what property management software do they use. A lot of these logistical things you want to know so you can make sure that it's a good fit for you. You also want to ask the property manager for references. So outside of anybody that referred you, you want them, the property manager, to be able to send you references of properties that they manage. Be able to speak to the owners of those properties, and you want to sit down, you want to talk with them, have a meeting, just throw a Zoom 30-minute calendar invite, and be able to talk to them, ask them specifics about what their experience was like working with their property manager, what were they good at, what they weren't good at. You want to really get the nitty gritty and an honest, unbiased opinion, and understand how it's going to fit your situation. The what may have worked for that operator, may not work for you, and vice versa. So you want to be very specific on why something didn't work or why something did work well for them, so that you can know how to apply it to your specific situation. And then if you want to take it a step further, you can also drive by the property manager's properties, some of the ones that they manage, to see how well they maintain in the properties. You want to see kind of what the tenant base is like and how they interact with property management. You may even want to go into the leasing office and just kind of inquire and see, how quickly the staff is responding, how engaged they are. A lot of times, the on-site staff's morale and the way they carry themselves in the office is a reflection of the property management firm. So you want to be able to get as much information as possible because this decision is incredibly important because that's going to be who's driving the success of your property. In conclusion, buying a multifamily property is a very serious decision. It's a commitment, especially if it's early on, if it's like your first, second, or third one. You want to make sure that you got your I's dotted and your T's crossed. You want to be very thorough and take a lot of these steps on the front end, and it's going to save you a world of headache on the back end. So it's very important that you come committed, you come correct, and you're thorough in everything that you do. All right. Thanks for watching. Hope you enjoy. Please leave a comment. Again, like and subscribe, and I'll see you in the next video.